Listen to me. If you are about to retire, or you have just crossed the finish line into your first year of retirement, I need you to stand up, go to your kitchen, pour yourself a glass of water, sit back down, and look me straight in the eyes. We need to talk. We need to talk about the massive financial shock that is waiting to completely blindside you if you do not wake up right now. You have spent 30, 40, maybe 50 years working for a paycheck. You knew how taxes worked. Your employer took the money out before you ever saw it. You got a W-2 in January, you filed your taxes, maybe you got a little refund, and you went on with your life. It was safe. It was automatic. It was predictable. But the second you stop working, that safety net is cut. You enter a totally different world. A world where you are no longer receiving one neat little paycheck from an employer. Instead, you are piecing together your income from a traditional 401k, an IRA, a pension, Social Security, and taxable investment accounts. And here is the terrifying truth that nobody wants to tell you until it is too late: every single one of those streams has completely different tax rules. If you do not understand how they interact, you are going to trigger a tax time bomb that will drain your hard-earned retirement nest egg faster than you can blink. Are you afraid? You should be a little afraid, because ignorance in retirement is expensive. I see so many beautiful, hardworking people who think, "Oh, Susie, I'm retired now. My income is lower, so I don't have to worry about the IRS anymore." That is a lie. It is a dangerous, financially catastrophic lie. If you don't pay attention, you are going to end up owing thousands of dollars in penalties and back taxes that you did not budget for. And where is that money going to come from? It's going to come out of your daily living expenses. It's going to come out of your peace of mind. Let's address the most common, burning question I get from new retirees. "Susie, do I even have to file a tax return anymore if I'm not working?" The answer is almost always yes. Unless your only source of income is a very small Social Security benefit and nothing else, you still have a date with the Internal Revenue Service every single April. The tax brackets are still there, the standard deductions are still there, and the IRS still expects their cut. In fact, right now, the standard deduction for a single filer is $16,100, and for married couples filing jointly, it is $32,200. Now, if you are age 65 or older, there is some good news. You get a little extra help with an additional standard deduction of $2,050 for single filers or $1,650 per spouse if you're married. Plus, under current tax laws, there is a special senior deduction of up to an additional $6,000 per person if your modified adjusted gross income is under $75,000 for singles or $150,000 for joint filers. But hear me loud and clear, just because there are deductions does not mean you are exempt from filing. You have to file to claim them. Let's break down the sources of your money, because this is where the confusion turns into disaster. First up, your traditional 401k and traditional IRA distributions. When you were working, you got a tax break to put that money in. You felt so smart. But that money was not a gift from the government. It was a loan. And now, the IRS is coming to collect. Every single dollar you pull out of a traditional retirement account is taxed as ordinary income. It is taxed at the exact same rates as your old salary. If you pull out $50,000 to buy a camper or pay off a debt, that $50,000 is added straight to your taxable income. And what about Social Security? This is what makes me so angry because it catches everyone off guard. People think Social Security is tax-free. It is not. There is a sneaky little formula called your combined income. To find your combined income, the IRS takes your adjusted gross income, adds any tax-exempt interest you earned, and then adds 50% of your Social Security benefits. If that total number is more than $25,000 for a single person, or more than $32,000 for a married couple filing jointly, up to 50% of your Social Security benefits become taxable. If your combined income goes over $34,000 for single filers or $44,000 for married couples, up to 85% of your Social Security benefits are subject to federal income tax. Think about that. You are being taxed on the money you were forced to save while working, just because you withdrew money from your 401k to survive. If you don't want to withhold from your monthly checks, your second option is to make quarterly estimated tax payments. This means 4 times a year, in April, June, September, and January, you write a check directly to the IRS to cover what you owe. If you don't withhold and you don't pay quarterly, the IRS will hit you with an underpayment penalty. They don't care that you're retired. They don't care that you didn't know. They want their money on time. The next actionable strategy is to master the art of the retirement income cocktail. Do not just blindly pull money from one account until it's empty. You need to look at your tax brackets every single year. You want to pull just enough from your traditional 401k to fill up the lower tax brackets, then use tax-free Roth IRA withdrawals or 0% capital gains from your taxable brokerage accounts to fund the rest of your lifestyle. Roth IRA withdrawals are your absolute best friend in retirement because they do not count toward your adjusted gross income, and they do not count toward the formula that makes your Social Security taxable. They are completely invisible to the IRS. Listen to me, your first year of retirement is the most critical financial transition of your entire life. Do not guess. Do not assume everything will just work out. If your tax situation feels complicated with multiple streams of income, use the free resources available to you. Look into programs like Tax Counseling for the Elderly, known as TCE, or ARP Foundation Tax Aid. They offer free tax preparation for people aged 60 and older. If your income is a bit higher, hire a certified public accountant or a tax professional for at least your first 2 years of retirement to build a bulletproof withdrawal strategy. You worked too hard for too many years to let tax penalties and poor planning steal your security. Take action today, fix your withholdings, map out your income sources, and protect your wealth. You can do this.